In today's video, we're going to do three things. We're going to review the metrics that could reward us with big safe dividends, find those companies with those big safe dividends, and then we're going to create a portfolio of those companies. But let's start with the metrics that I typically use when I decide whether or not I'm going to invest in a particular company. So typically I look at things like the PE ratio, earnings per share, payout ratio, 5-year dividend growth rate, the years of increasing dividend payments, the 10-year total return, free cash flow, dividend yield. And I do like to see a company who's doing some buybacks because less shares on the market means the value of what I own is going up. But after reading The Little Book of Big Dividends, A Safe Formula for Guaranteed Returns by Charles B. Carlson, CFA, I've come to learn that there's some other metrics that maybe I should consider, so I thought I'd share them with you all. The beauty of this little book is that while it was published in 2010, it still contains a plethora of good investing standards that bear looking at and learning about. For one, Mr. Carlson created his own scoring systems that he refers to as the BSD score, an acronym for Big Safe Dividends, and he developed the Quadrix rating system. His Big Safe Dividend score includes 10 key metrics, which he weighted based on level of importance when evaluating a company for its ability to provide its shareholders with those big safe dividends. Let's look and see how this all breaks down, because we're going to use this information to try to find the best companies who will indeed offer us those big safe dividends. And because I love a good visual, I took the 10 metrics and created a pie chart so we can see how he weighted each one. As you can see, the payout ratio got the largest piece of the pie at 30%, because to be a big safe dividend, you have to have the cash flow to cover the dividend being issued to its shareholders. The second item listed is interest coverage at 10% of the pie. This essentially allows us to look at the relationship between the earnings before interest and taxes, or EBIT, and the interest expense. Because if a company has too much debt and has to make large interest payments and pay its shareholders dividend, guess what's getting cut? Most likely the dividend. Next, we have cash flow at 5%, followed by dividend yield, also with a 5% weighting because, well, we don't chase yield. 6-month relative strength, weighted at 10%, and it measures the share price performance over the last 6 months. And if you pop on over to Seeking Alpha, you can view this pretty easily by using the charting tab. And here's Microsoft over the last 6 months with its price performance clearly outperforming that of the S&P 500. Next on the list is tangible change in 1-year book value, also weighted at 10%, followed by long-term expected profit growth at 10%, the 3-year cash flow growth with a 5% weighting, the 3-year dividend growth at a 10% weighting, and finally, the 3-year earnings growth at a 5% rating. Now, all of these scores are available on the Big Safe Dividends website. And here, you can actually download all of the data and pop it into a spreadsheet of your own so that you can further dig into the information. But before we do that, we probably should talk about the other piece of the Little Book of Big Dividends, and that's the Quadrix rating. Mr. Carlson, he takes it a step further, and he adds his own proprietary Quadrix score, which is a stock rating system created to spotlight stocks that demonstrate balance and broad strength. You can see here that Quadrix ranks roughly 4,600 stocks based on more than 90 different variables across 6 categories, including momentum, which is inclusive of growth in earnings, cash flow, and sales, quality, which is inclusive of return on investment, return on equity, and return on assets, value, which includes price to sales, price to earnings, and price to book ratios, financial strength, including debt levels, earnings estimates, and the relative stock price performance. Within each category, some variables are weighted more heavily based on past effectiveness. To compute an overall score, Quadrix uses a weighted average of the 6 category scores. The overall score is a percentile ranking, so a stock that has an overall Quadrix score of 90 means that it scores better than 90% of the stocks in the Quadrix universe. The best way to use it is to focus on stocks that score in the upper quartile, so 75% and above. And the beauty is that we can use both the BSD score and the Quadrix rating to find the very best, biggest, safest dividends, and I'm hoping, in addition to using these scores, you're going to weigh in with your own experience in valuing companies. Has anyone read this book? Have you guys visited this website? We're going to use these 2 rating systems to help us with initial company selection. I'm going to drill down a bit further, and the goal is going to be to start a portfolio with the companies that we identify. Then we can monitor the portfolio from time to time and see the progress we're making. Of course, I'll link the website and the book, totally worth the read, in the comments below. But let's start looking at some of those companies that we might want to invest in so we can capture those big safe dividends. Step 1 for me was to download all the information into a spreadsheet and sort the S&P 1500 listing to look for companies who scored in the 75th percentile for both the BSD and the overall Quadrix score. Step 2 was to find all the companies with a 10-year total return that beat the S&P 500. And after doing that, I was left with a total of 51 different companies to delve in further on. Step 3 was to add a few more variables. Specifically, I wanted companies with a 5-year dividend growth rate of greater than 10%, with at least 10 years of dividend growth and payout ratios all less than 40%, so that those companies have plenty of room to continue to pay us those dividends. And this brought me down to 18 companies total. Now, some of the companies I'm familiar with, some I've never heard of, so I'm planning to do my due diligence before I hit the buy button. I've made that mistake before, but stay with me because I'm not done yet. My next step was to then look at the sectors for each of these companies, because if I'm going to try and create a portfolio of the strongest, safest companies, it would definitely be smart to look at the diversification that a portfolio like this might offer. If I chose to create a portfolio including these 18 specific companies, I'd have 5 in the industrial sector, 6 in information technology, 1 consumer staples, 3 financials, 2 materials, and 1 in the healthcare sector. But in doing so, 50% of my assets would be in industrials and information technology combined. How comfortable would you guys be with taking this approach? And in looking at the overall diversification of my total portfolio, I only have 7% of my holdings in industrials and 4% in information technology. So I'm thinking of doing an experiment by creating another dividend investing portfolio in my M1 account to see how it stacks up against my existing M1 account. And then we can track the performance over time. What do you guys think? But before we make any decisions, I did backtest this portfolio. Now, I know backtesting doesn't predict the future, but come on, aren't you guys just a little bit curious? I know I was. So here we are, Portfolio Visualizer, and here's the parameters that I set. I'm looking at a 10-year time frame from January 2013 to December of 2022, so a full 10 years of data. An initial deposit of $1, $400 a month to be continuously contributed over the course of those 10 years, no rebalancing, and we're going to reinvest those dividends and see what we find. And because there's 18 companies, the math was a little off, so 17 of the companies are weighted at 5.5%, and then Microsoft, we gave 6.5% in this portfolio. So this would be the allocation. And for purposes of comparison, I set up another portfolio where we're just investing the same amount of money into VOO, so we've got an ETF with the S&P 500. 10 years of contributions at a rate of $400 a month would be the equivalent of $48,000 at the end of the 10 years. In the BSD portfolio, the final balance would be $136,903, which is equivalent to a 226.32% compound annual growth rate. If we invested the same amount of money in VOO, our final balance would be $87,979 with a compound annual growth rate of 212.2%. So I'm going to sit back and wait in the comments for you all. I'd love to hear your thoughts. Should I do this experiment? I'm kind of excited about it. But would you be comfortable with the existing diversification? Would you be comfortable with 18 holdings? But of course, bear in mind, I already have a pretty well diversified portfolio. This is just kind of an experiment to see what's going to happen. I can't wait to hear what you guys are going to say. So let me know in the comments below and then go and take a peek at this video next.